Excellent. Well, today I'm joined on this episode of the Insurtech Leadership Podcast by Goetz Weber. He is CEO and co-founder of RouteRisk.ai. RouteRisk is building a forward-looking risk layer for commercial fleets, one that converts a planned route into a structured, priceable risk score before the truck ever leaves the yard. We're going to dig into why historical data and dashcam footage aren't enough to price commercial fleet risk, what it actually takes to score a route dynamically across 60 plus variables, and how this kind of data could reshape the relationship between fleet operators and the insurers who underwrite them. Welcome, Goetz.
Josh, thank you very much for the kind words and introduction. Really a pleasure to be here.
Yeah. So you have a super interesting background, and maybe you could just share a little bit of that and how it led to you founding RouteRisk.
Perfect. Thank you very much. I have been a software entrepreneur and most recently spent about a decade in the mapping business with two of the very large non-Google mapping players. One is called HERE Technologies and the other one's called TomTom. And I moved through the echelons of those companies, becoming moderate, well acclimatized to routing, map data sets, and so forth. And increasingly over the last few years, the fleet management space, which is an area that has interested me increasingly because fleet management, the actual operational fleet management, is a very costly and complex and risky undertaking. And over the last year and a half, I've focused on one of the big problems that I believe exists in the market, and a problem that I believe I can solve, or at least try to solve, which is this world of macroscopic risk that the fleet operator lives in on a day-by-day basis. And this macroscopic risk is all centered and anchored in the movement of trucks through space and time. And that's in the jargon of fleet management, that's called routing. In the jargon of mapping, that's called routing, right? Whether the fleet management system, Samsara, Geotab, Motive, and all the other good players in that market, the commonalities is the problem of routing these many trucks across the most complicated and dangerous routes that exist. And the observation I made some time ago is that there's a problem in the market that I'd like to solve for, which is the fact that when something goes wrong in the trucking space, we're not talking about the last mile delivery. It's not about the pizza delivery that goes from the restaurant to your home. We're talking about large trucks moving across dangerous terrain, the so-called middle mile of delivery, the world of hazmat, of dangerous goods. What I've found is that when something goes wrong, the accumulated economic damage done to the Americas is about $100 billion. That's a significant amount of money, right? And the insurance premiums that are cut in the market are of the order of $30 billion. But the actual economic damage of a truck hitting an obstacle and all the subsequent consequences, cost to the operator, cost to the environment, cost to the society, is of the order of $100 billion. And there are many data sources that argue it's larger and slightly smaller, but that's the magnitude of the problem that we're facing. And that is a problem that I believe I can help address with my solution called RouteRisk.ai.
Got it. And so this comes into a market where I think commercial auto liability has had a pretty tough run for quite a while now. You've got nuclear verdicts out there that are massive, and most of the data, from what I understand, insurers using to price fleet risk is still fundamentally backward looking. So loss history, driver records, maybe dash cam footage. I know there's been an announcement of a Cambridge Telematics Allianz partnership recently, but maybe you could share more detail about what you're trying to do to kind of flip that model and score the risk before the trip starts.
So I appreciate that context, and you're absolutely right. So let's take a step back. Insurance and insurance pricing and the focus of the fleet management companies or the software companies in that space have really focused on two variables, which is historical data. In other words, accidents, incidents as a function of time and road segments. So something has happened there in the past. And then we have the increasingly sophisticated world of video telematics that looks out of the vehicle in real time, observes issues, looks into the vehicle, monitors the driver for fatigue signals, and so forth. So we have data about the past, we have data about the present and what's happening in the present. And those are solutions and systems that exist today already. And there are many players in that market, again, with increasing sophistication as it comes to computer vision, artificial intelligence, driver-based monitoring, coaching, and so forth. And there are many players that are offering solutions in that market. And that's the historical approach and the current approach to managing risk. The past, the present, and coaching the operator or the driver around safety features. There's a gap that I've identified, which is what I call forward-looking risk, which is a FICO score, right? FICO being the credit score for the consumer market or for the lending market. It's a FICO score of the routes that you will travel. So it's not the past, right? That's been solved, and that's a very important ingredient, obviously, in the actuarial space for the insurance company. It's not the present, which is the video telematics world and the instantaneous observed world, which is what the cameras do, right? And that's the world of Samsara and Geotab and several other players, Draven. But this future-looking route, risk, is an index that I've created, which is a machine-learned risk index of the route that you will travel. Now, that route you may travel in an hour or 2, 3, or 4. But what I am creating is a risk scoring factor of the portfolio of routes that the operator will travel upon. So the trucks in the operator's portfolio. And I score these in a machine learned index. And what I enable is the operator to choose alternative routes to reduce that overall risk factor. Now that comes at a price, because an operator is operating under constraints. ETA, I have to get there on time. SLA, I have made a commitment to you, Josh, to deliver the hazmat goods or the medical goods at 3 o'clock tomorrow, right? But there's a third primitive that I've introduced here, which is the risk factor, which can now be traded off between these other variables. And that risk factor becomes quantified, and the dispatcher, the risk manager, the operator can say, okay, I'm going to relinquish the SLA. I'm going to place a call and say the materials will be late in exchange for reducing the operational risk of the truck that will enter that dangerous zone. So this is a new primitive on equal footing with ETA and SLA, giving the operator a quantified measure of risk. Now, they do it today, but it's anecdotal evidence, and it is often limited to weather data.
Yeah.
And so with our history, the company's history of machine learning, artificial intelligence, the world of mapping, right, and the world of dynamic data, what we're fusing are data sets at a road segment level and as well as a route level. We're fusing data sets that include the category of the road. Is it an incline? Is it a decline? Is there an angle to it? Right. Those are the map data, high quality map data elements. We're looking at weather, precipitation, wind speed, and so forth. And we have about 60 to 62 variables that we bake into this RouteRisk score that we then present back to the user and say, here is a measure of the risk that your fleet is entering into on this route. You can ignore it, or you can take an alternative action. And that is empowerment of the operator.
Yeah. And is that route FICO score or route score independent of the driver and the vehicle and the cargo, for that matter?
This is actually a very interesting question, and thank you for raising it. So we've had we've spoken with many fleet operators, and fleet operators are asking us to modify the score in many ways. One is a function of the operator. So this person has history of driving on snow. I don't. So the dispatching this person who has experience on driving on snow should have a different risk factor if he or she encounters snow. Now, the physics of the vehicle also influences the risk, because an empty trailer, right, that is tall, has a different relationship to the physics of wind than a full trailer. Moving a bunch of bananas from A to B, right, that are exposed to cold temperatures also includes like the notion of cargo risk.
Yeah.
So what we're doing right now is we're breaking this risk factor into three components. The bare bones risk factor, which is purely environmental. Temperature, wind, and so forth. Then the second risk factor is the driver's side risk index. He or she who's operating the cab, what is their core competency and what is their risk factor in relationship to that route? And then the third one, which is a really complicated one, is the physics of the vehicle. And as you can imagine, this is a very complicated multivariable analysis. But our strategy right now is to offer the first version of the risk factor, which is this bare bones risk factor. We call it R1, to everybody, and then modify it according to the needs of the operator. And let me digress. So one of the things we heard is that if you're moving expensive electronics, think of NVIDIA GPUs for the time being, right? You probably do not want to park the vehicle in an area that is known for theft.
Yeah.
Right. And so that's a risk index that's again a function of the cargo. So as you can see, this risk index becomes increasingly nuanced the more questions you pose it. Therein lies the opportunity, and there, of course, lies the complexity.
Yeah. And so let's just say there's a 500-mile leg. My terminology is probably wrong, but and there's three types of cargo on a vehicle, and there's going to be 3 stops along that 500. So are you scoring that whole route from the beginning? Are you scoring leg to stop? Are you scoring in different increments that have nothing to do with that? How does that work exactly?
I think the best. I appreciate the question, and it's not an easy one. So let me show you a demo because it makes things very, very specific.
Sure.
The atom, right? The atom of the risk is the route segment that you will traverse. But a route is many, many, many segments. I can show you a demonstration of a route with 5,000 segments, right? So the risk is a function of the segment, but also a function of the entire route. And to make it very concrete, let me show you. I'm going to go into presentation mode, share screen. Question, do you see my website?
Yes, we should be good.
Thank you. Perfect. So let's start here. So RouteRisk.ai is route intelligence for fleet operators, dispatchers, and risk managers. And the insurance angle we will discuss shortly. So we are creating a variable, a number. So actually, specifically, it's a vector, but that's technical. It's a number that adds the notion of risk alongside ETA and SLA so that fleets can choose the route which best meets the overall decision quality. So we're putting risk on an equal footing as estimated time of arrival or service level agreement. Let's make it very concrete and show you a real-time environment. So I'm going to go back to your question, Joshua, and make it very concrete. We are operating a fleet, Josh, you and I, and we are delivering hazmat materials or medical equipment from Sacramento to Reno, and we're going to be driving past Carson City. And it's 2 o'clock in the afternoon, 6 o'clock in the morning, And we're using, for argument's sake, one of the large fleet management systems, and I'm not going to mention any names, not to bias, but the fleet management system, and this is really important, the fleet management system proposes a route from Sacramento, the warehouse, to the recipient just outside Reno. So that now we're firmly in the dispatch system of the fleet management system. Now we are a RouteRisk client, and the truck hasn't left the warehouse yet. But let's move to the next step. RouteRisk now is given that route, right? We do not create routes. We just are given routes via an API, and we start looking at what's happening on these route segments. So as you can see, these segments here are perfectly normal, but there's something brewing here. And as time progresses, and please note the score down here, as time progresses, there's risk accumulation on these segments, right? The truck has not left the warehouse yet, or maybe it's just gone the first 10 miles. But there's something here, and this something is risk factor, if you noted, has increased. So what's happening is that the risk factor that's quantified is now observing, or my system is observing, that there's wind, there's precipitation on these areas of the road which have incline. And so as time progresses, I'm noticing that on these segments now we have accumulation of risk. The truck is still meandering along its way towards Reno, and I'm flagging this corridor. Now, as the truck is approaching the first decision point, which is an alternative route, the fleet management system proposes a new route, which has a lower risk score. Now, it's very important. I do not propose routes. I take the new proposal, which is this route, and I score it, and I show that this route has less overall risk. That's the 0.7 saved. And the next step would be that the truck is then dispatched along this new route. So again, let's play the video. We start from a route proposal in the morning. We observe risk factors along those routes. The truck is leaving the station. The risk is accumulating because there's additional wind or additional snow and so forth. And the fleet management system now looks for alternative routes. I score each of those alternatives, and the operator, right? This is the operator, this is the fleet manager, this is the risk manager in the fleet company, is given an alternative to reduce the overall macroscopic risk of that route, and chooses an alternative. They have alternatives to choose from. For example, they could delay the truck. They could ask the truck or the vehicle to stop at a holding zone, etc. But we have quantification of forward risk and then the decision plane that the operator is now given.
So from a practical point of view, how would this work? I mean, would your platform sort of be proactively scoring a set of routes that are loaded in every day or whatever the interval is, and the dispatcher shows up for the start of their shift and says, hey, we flagged these 5 items where you want to maybe take a look at alternative solutions, and then they drill down and see what the issue is and what the recommendation is, and then they decide, kind of human in the loop style, whether they want to take action or what action they want to take? Absolutely.
So every fleet operator has an implicit operational attitude towards risk. Some of them are willing to absorb more risk, and some of them are not, right? So they have what I call a minimum threshold. And let's call that a number. Let's say that it's 2, right? And we can talk about metrics later.
Yeah.
But as a fleet operator, I'm moving bananas from A to B, and that it's not hazmat, right? So my appetite towards operational risk or environmental risk is slightly higher than you, who's moving medical equipment, right? And so, given the set of routes that my banana transporter will be executing, and given this minimum threshold, right, what I do is I provide the risk scores back. In addition, I message the operator that the risk score on a given route has exceeded the minimum threshold. So I'm sending a warning signal. I'm not changing any workflows in the fleet management systems, but I'm just saying that the the credit score, so to say, has decreased on that route. And that's just a signal that you can subscribe to. And then the operator actions that or not. But again, I do not change any routings. I do not compute any routings. I am just observing the risk factor of a route that you give me. And if something changes along the route in terms of risk, I message you for you to do the human in the loop operations.
Got it. So I'm assuming like aerospace has been doing this for some time, because we've all been on flights that have been rerouted at one point or another. So is this the same as what they're doing, or is this somehow different?
That is a fantastic analogy, and yes, there is something very close here, which is the flight plan that you're taking from going from Atlanta to New York, right? That flight plan is fixed, but there's something happening along the route. There are cloud formations, and there is a deviation that the flight plan or the trajectory will take. Now, there's one big difference between motion through a road network and motion through airspace, and that the road network is constrained. I mean, you only have a finite set of options to go from A to B, and that's determined by the road network. On the flight plan or in the airspace, a priori, you have many, many options. You can go to left, right, up, down, and so forth, right? But that is so we're operating on the ground in the world of navigation, on terrestrial navigation. We're operating on the fundamental premise that the number of options that you have are limited. And that's where RouteRisk comes in, because it can say that given the configuration, right, of the vehicle and given the configuration of the load, certain options are not available, certain options are available. So the analogies are very similar, but the fascinating part of this problem is that you're operating on a fixed road network.
Could someone do most of this just kind of leveraging a commercial version of Waze?
Good question. So, we've looked at, obviously we've studied Waze, which is a fantastic service for the consumer. Now, the results of Waze are generally that you avoid congestion, that you're given an alternative route. Right? In fact, Waze suggests an alternative route. What we're doing is we're trying to reduce the overall macroscopic economic risk, and we can only do that by conflating and analyzing a large number of variables that are very specific to the fleet management space. And Google and Waze historically have been consumer applications, and they do not a priori they have not focused on the commercial fleet market, which is different in data sets. So in terms of data sets that are required, we're looking at things like, can this bridge be crossed by the truck? Is it high enough? Is it allowed for that cargo category? So the complexity in fleet management routing, not that we do it, right? That's something firmly in the hands of the fleet management systems, is much, much higher in terms of constraints on the routing algorithms. We're just augmenting those routing algorithms with the risk score to give the operator additional choices. So Waze and Google are typically consumer products, whereas we're focused on the complexity of the actual operations of fleets.
Got it. And in terms of how you envision the insurance industry adopting this technology or recommending their clients adopt this technology relative to, say, some of what's been done with telematics or some of the mapping services maybe that you've been involved with, et cetera, what's similar and what might be different?
So I appreciate the question. So we, as we understand it at this point, premiums are priced based on history and based on performance metrics or historical metrics, usage metrics. So it's historical data. What we're creating over time is insight into the actual operations of the fleet. their choices as it pertains to risk. Do I ignore weather risk? Do I ignore precipitation? Do I ignore snow and so forth? Right? That's an operational choice. So the company that you operate, Josh, and mine, even though we operate in exactly the same fields of business inside similar territories, right? My approach to risk is very different from yours, which is I completely ignore the route risk score. And in your case, you make the deviations to avoid Tahoe when it's snowing. Now, those are operational decisions that we believe insurers do not have insight into. So what we see, what we believe is that these data sets of actual operations of fleets pertaining to forward-looking risk will become material in the pricing. But that is to be determined over time because of the historical approach of insurance on the past data sets and increasingly video telematics, which is still in its infancy as it pertains to Insurtech.
Is there a chance that it's going to sort of start with a high level of selection bias because the fleet operators most likely to adopt this are the ones who are already the safest operators and looking to get to the next level? Or does that mean the data skews toward the fleets that don't actually need the better pricing? Or how are you thinking about that, or maybe solve for that?
So, good question. Our data points are as follows: that there are fleets that are very safety aware and driver aware. So, safety is a big issue because of the cost of non-compliance to safety being so high. Drivers are becoming scarce and increasingly important in operations. So there are sort of what we call lead users in the fleet space that are focused historically on running tight safety, tight operations, both from a safety perspective as from a driver safety perspective. These are the clients that we see adopt scores like this early on because it's another quantifiable metric. Remember, we're moving anecdotal evidence about the routes to quantified evidence. And so there are operators that are already sensitive to risk and to driver side exposure that are amenable to quantification. And that's the go-to-market.
Got it. So maybe before we run out of time here, could just talk about your approach to building a business. You said you've got a lot of experience in entrepreneurship, whether it's your own businesses or working in entrepreneurial organizations, but you do have the background as a physicist, and you discuss things like fields of risk, which is probably more of a physicist's way of describing it than maybe an insurer would think about it, or certainly someone like me might think about it. So how does that all come together into your approach to building a business and trying to nail down the go-to-market strategy and build something meaningful?
That's a multi-layered question. I appreciate the commentary. Yeah. So, two things that I've learned in the entrepreneurial world is pick a big problem and solve for it. And this is a material problem. We're not optimizing SLAs by 1 or 2 seconds. What we're doing is we're trying to remove $100 billion of risk out of the economy. At least take a portion of that out of the economy by providing tools and systems and decision-making systems to customers that live this risk every day. Right? So this is a big problem. So that's good as an entrepreneur, right? And then the second thing as an entrepreneur is I've been coached on, you have to know what you don't know. So I'm very comfortable in the notion of road networks, risk fields, data pipelines, machine learning, all Monte Carlo algorithms, right, that are necessary to build this environment, but they're not sufficient. Right? Because ultimately, success of a venture, of a technology venture, is always around adoption. So what I will be doing is augmenting the team with skill sets from folks that are very comfortable in Insurtech, because I have to build a bridge to the insurance companies over time to provide them with the appropriate metrics. That's not an industry that I'm familiar with. And then I'll be working with the fleet companies to integrate this risk score in their decision-making environments. So we'll have multiple vectors, and as we build this company, we'll have the technology stack, then we have the Insurtech sector, right, that we need to address. Then we have the fleet space, because our system needs to be made visible, or the data needs to be made visible and executable by the operators. And then we need to wrap that whole thing into a go-to-market strategy. And that's my next step.
Got it. So if you were to give, one piece of advice to folks in the fleet space right now about this problem, and one piece of advice to folks in the commercial insurance, commercial trucking space about this problem, what would that be, or what would those two pieces of advice be?
The commercial fleet operators are under increasing pressure when it comes to driver safety, driver availability, insurance premium, and overall operational cost. So the cost of making a mistake is increasing. Let's focus on reducing the number of mistakes and increasing the number of options that people have in the daily dispatch and the daily operations. Right? And that's where I believe we can help, in addition to the video telematics folks, in addition to the data providers, etc. So that is an area. Let's reduce the risk and reduce the number of nuclear accidents or nuclear verdicts that this industry is plagued by. Right? That's at the operational level. On the insure side is fleet operators have different appetites to risk. And let's find a way of surfacing this FICO score in some way that shows that Fleet A operates at a different risk appetite than Fleet B. And as such, they should be treated differently from an insure perspective. That's really it.
Great. So Goetz, it's been great having you on. Anything else you'd like to share before we wrap up today?
Pleasure being here. Thank you so much for a really great video blog, and hope to be back soon.
All right, fantastic. Well, excuse me. Goetz Weber, CEO and founder of RouteRisk.ai. Thanks so much for joining me on the Insurtech Leadership Podcast.
Joshua, thanks.